But we do want to return to the oil story. You just heard that report from Francine Lacqua covering OPEC in Vienna. So what is the price of oil saying about the global economic recovery? Stephen Schork, president of the Schork Group and publisher of the Schork Report, is our guest. Welcome, Stephen.
Thank you, Lori. Great to be here.
Great to have you. How much further will a falling dollar drive up oil prices?
Well, according to our calculations, which I tell my readers in our daily letter, if we get another 4% fall in the dollar in the month of September, we can see, given the correlation to the dollar, we can see oil at $78 by the end of the month. At the end of this month. Now, I don't suggest for any stretch that is legitimate or that is justified, but just given the historical relationships between the dollar and crude oil, should the dollar continue its fall, we will see oil prices push higher towards the end of the month.
And what about the inventory? Last we spoke, you were a little more bearish on oil prices, saying we were awash in inventory.
Oh, fundamentally, Lori, nothing's changed. I'm as bearish as ever. Look, the OECD oil supplies are well over 60 days forward cover. That's well above historical norms. The gasoline driving season in the Western Hemisphere is over. We have distillate fuel oil, Lori. This is heating oil for the winter and diesel fuel for industry at the highest level since October 1983. And mind you, we're still in the midst of the greatest economic contraction since the Great Depression. And yet what we have done, Lori, is we've put the cart in front of the horse. Speculators jumped into this market. They pushed prices higher on the guess that demand will catch up to prices. That's backwards. You need economic demand to push prices higher, and prices will move higher along the ways, but it's not working out that way at this point.
And Stephen, I'd like to bring in my colleague Michael Whitney, who covers the commodities market.
Sure.
Yeah, hi, Stephen. Very much to your point, you're talking about the market being awash with physical supplies. Talk to us a little bit about the structure of the market. We've seen in the last couple of days, we've seen this contango tighten a little bit. Do you think that has something to do with the threat that the CFTC may try to rein in some of the oil speculators?
I mean, it possibly can. And as for your listeners, a contango is prices going out into the future become more expensive. So as you go out along the x-axis, you're moving from the bottom left to the upper right, and that's flattening. And that would, Michael, you're correct, would be a sign that there is fundamental demand moving into the market. But the contraction at this point, we're still in contango. And more importantly, we've been in contango all year long, not just in the oil markets, but also in the natural gas markets, so forth. So the signal going forward is still clear that fundamentally the market is not concerned with demand given the current level of supply. I'll give you a great example. In the natural gas market, gas for this winter, which is the peak season for natural gas, is trading below gas for next summer. And it's been that way all year long, and the winter continues to weaken against the summer. That's not supposed to happen. That is clearly a sign of a market that is oversupplied and under demand.
Hey, Stephen, Michael,
yes.
We have to take a quick commercial break, but hang on, we'll continue our chat after a short one. Let's continue our conversation now with Stephen Schork, president of the Schork Group and publisher of the Schork Report. So, Stephen, thanks for waiting through our commercial break and our breaking news here for us. Let's talk about OPEC. The Saudi Arabian minister saying current prices are good for everybody. I mean, does that $70, give or take, strike the right balance globally, driving growth while not fanning inflation?
Well, if you're selling oil, it certainly strikes the right chord. But in this, and I will preface it also that oil in between $70, $85 in a healthy economy is certainly justified. I mean, that translates into gasoline at the pump between $2.50 and just over $3. I think in a growing economy that can be sustained. In this economy, I do not think it can be sustained. I do not think it is justified. Demand is currently weak. We are oversupplied, and I think we are now trading in a technical range, Lori. Last week, we ran into support in between $67, $65. There was a key technical area signal in that area. We held that support. We bounced back, and now we're running up and looking like we're going to make another run towards $75. Doesn't mean it's justified. I'm of the mindset that oil closer to $60 from a consumer standpoint is more in tune with reality.
Hi, Steve. What, if anything, can OPEC do to rein in the cheats? By this, I'm talking to the guys that produce oil much above their stated quotas and the non-OPEC production. Russia now is a huge producer of oil, and they tend to push out the oil as much as they can and just let Saudi Arabia take the hit for the rest of the group.
Now, as you know, Michael, I usually attend these meetings. I didn't go this year or to this particular meeting because I'm not expecting much from it. But that said, what can they do? They can't do anything. They can't do anything about the Russians, and the Russians are now now producing oil or exporting oil at pre-Soviet Union date or pre the collapse of the Soviet Union. So there's nothing that the Saudis can really do at this point. The only thing they can really do is put more oil on the market, since they are the marginal producer, and really drive down the price for the other people. But I don't think they want to do that.
Thanks, Stephen.
All righty,
Back
Lori.
in a moment
Thanks, Michael.
with more Bloomberg News.